Today, gold plummeted b sishuwu drop, but because eofafat that almost no needs discussing, right no, the Federal Reserve strapped, it cannot trazerates, and it cannot catrates, itis corner dinthimostex, stremedendithas faciden 4 years. The last time a central bank fell into this skinned-off paralysis was in Feijo Chi R. Back then, gold surged from Bawulin, Aganoff over Shisen times. When a central bank loses its sense of direction, that is the true starting point for gold tokake flight. Tomorrow, the April data will be released. Wall Street expects the annual inflation rate jump from 5% between 5% and 5% ba. No matter whether this number comes in higher or lower than expected, it will push the Fed deeper into its predicament. Historically, every time a central bank has been stuck in this kind of corner, former rethinaments, gold is entered a majorable, market that leaves every honestend, this window may have adjusted. Welcome to Light Jan on Jan Insight. In this episode, I will walk you out through 3 things. First, with that locked in, what happened to gold, the last time we saw this scenario. Second, behind this Jan week. Shu, dropping gold, a massive shift in market, participants, shappening Greichunder, Uranos. Third, no matter what, number Thekpire ports tomorrow, what does it mean for your wallet, and what 3 specific things should you do this week. If you want to keep today's analytical framework for reference, please watch until the end. I have prepared a calibration tool to help you stay clear Jan headed during the coming volatility. Let's take Senchimals a consto explain theorial transmission, chain of today's drop, because it's not what your intuition tells you. Most people's first reaction is, there is a war, gold should be going up, so why is falling? But there less of, Liancenin Arshilio Gonsim Vebin rewritten, theorial chain is, Trump refused to negotiate, the Strait of Hormuz faces renewed blockade risks, and oil prices jump, sen at the open, higher oil prices drive up inflation expectations, which means Thev does even less like let a cut rates, higher interest rate expectations, drive dollar up, which ultimate, like crushes gold prices denominated dynast, the strategic Kifatas bank, Jason Wong believes the market is entering a risk, Jan off mode, but the risk, Jan off capitalis fleeing jinta theu, s, Dolaran treasuries, not gold, in other words, intha, liauncenin arshiliomi, arket pc sabun for gold, while warissa headwind. This completely flips the textbook upside down. Butansi understand this counter Jan intuitive rule, you can understand today's entire analysis. Now, let's look past today's Lushisen to Bawulin in Fajobalian. Gold doesn't Gupen crisis. It goes up when central banks lo set their direction. Kreis Shavius Startandanend, Butansi central bank lo ses their way. Their recovery takes years. If the feed being trapetus as structural boon for gold, witted drop, Ardern Joyi billion, the largest single, Jan der redemption in a decade. Through Houtmay, global gold at Fesawanet, Houtflof, Edern Wu billion from North America, and Sishawu again today, yet Goldman Sachs still maintains Wu Chenyang by forecast, when the top Jan tier institutions don't just hold their targets butrafir, them duringa price drop, it's note about saving face. It's because SD sheath bottom Jan layer chip structure, they tail investor scant, fast money is clearing out, and slow money is getting into position. What happens if Fivrisuk handover in history? BNP Paribas commodity strategist David Wilson provide a precise historical framework. He says gold's reaction to macro shock shaskolier precedents. In Fei Linimba, 2020, and 2022, gold initially fell during economic shocks. Then rebound data investors repositioned. March 2022 is the most recent example. Gold crashed over Bafindashar, amid global liquidity scramble, ETFs, some severe redemptions, and fast money was washed out. But after the handover, gold rose from 2027 in Feiba Amo Once, a Fei Bafindasang gain. Every dip during the handover period, in retrospect, was a buying opportunity. Why is early after a handover so much stronger? Because ship shave moved from the hand soft sos were not the firsts. Signof wind. Toth the hand soft tos wones 11 under duress. When Theon Lee people left in the marketeers slow money, any buy Jan order triggered be good news, swant be offset by profit, Jan taking sell Jan orders, the resistance rising prices is cleared away by hand over process itself. Now, tithe hand over logic to the Fed dead Jan end. Wido's fast money run because of short, Jan term or driss oil, which drives inflation expectations, which kills rate, Jan cuthopes, which keeps rate shay, suppressing gold. This is the interaction for today's 45美元 drop, but Wido's is slow money buy because ICCD per reality. The Fed is locked in, meaning they cannot truly suppress inflation by continuing to resurrect. As long as inflation remains, Sensusauscher Egerthen interest rates and real interest rates remain negative. Gold's structural bullish logic cannot be broken. Fast money watch as tomorrow's Fed decisions. Slow money watch as whether Fed can scap this dead end over the next 3 years if and swear snow. The never dip today is just a no thirchens for slow money topic up chips. Once you understand the logic of the handover, you can tease. Long Jan term, there is no problem. But P will burles at tomorrow morning. Its result will decide whether handover window is closing faster or being forcefully extended. If you don't understand the following analysis, you are very likely to make a decision tomorrow after the market open stat will make your read the next 3 months. Wall Street's consensus for the April PISA monthly ratio of 0.6倍 0.7 and an annual ratio of 3.7 倍 3.8, a jump up from March's 3.3. Beauty One McKee prediction. Beck is predicting specific pin versus a gamble with very low win rates. What Tito is more valuable. I'll give you a framework so that the moment the numbers come out tomorrow, you will know exactly what I mean for you, without needing Gagnon set to tell you. Scenario, ASAP I come Sinheiger, than expected annual rate of 5.7 or above. Inflation acceleration is confirmed. Rate and cuthopes are shattered. The dollar stays strong, gold may drop further. The handover window ice extended, and volatility intensifies, but the mid, dan term decisive and more bullish for gold. Why? A simple calculation, nominal rates are 3.5非 3.75. If inflation is 3.8, theoreal rate is -0.05 to -0.3, enter negative real, January territory. And what is negative real rate? It is the common prerequisite for every super bull market in gold. History 1970秒 2009减201万 1219减2020. Every major wave happened after real rate is stern and negative. The higher the inflation, the more Fed is paralyzed. The more negative theoreal rate, the higher the structural bottom of gold. The harder it dips short and term, the more throw the handover, the cheaper the chips for slow money, and the stronger the eventual rebound. Scenario CP com sin low worth the nor matches expectations. Annual rate bellow by Wu. The market brief. Licher stat inflation has peaked. Rate and cuthop pesrises lightly. Gold rebound short and term, and the handover window close as faster. But don't celebrate soon. Trump just rejected Dear Pisa talks. WT oil surged by 5% again, and the inflation and geofoil pressures just been reignited. One equal sulpiri dingdos ends change at that trend. Regardless of which crowd is taken, theft's predicament will not be solved in the short term. JP Morgan built Threk Pi models, optimistic, neutral, and pessimistic. The conclusion, even in the most optimistic scenario, where the Middle East settles quickly on oil prices retronormal, it is impossible for you. Annual Peter return to the 500 policy target before February, 2024. That is to say. Theft will best account this corner for it. Lisnamo remnants, in the senements, every uneo furu. Dollar bills will be losing purchasing power 10 annual ratio of 500 to fay and theft can do nothing about it. In this environment, gold's role lies in justice of a haven. It is an insurance policy Yagan central bank paralysis. Lastly, there is a technical detail schuld notice. Zillow's analysis points out that the housing portion of April's SPI will see mechanical jump. A government shut down last October cause rental data be missing, and this data will be back, den filled in tomorrow's report. OERS expectators be 0.04 monthly, of which 0.02 is just back, den filling missing data, and only 0.03 is the actual growth for April. In other words, tomorrow's SPI figure will contain FOC inflation caused by statistical adjustments. If the market panics and sells gold due to this technical jump, it creates a short, dan term buying window created by statistical illusions. Hearing this, you might think, since the bullish long jan term, I'll just hold tighter at my position. But the thing Jim about to tell you might make you reconsider. In the handover window, Those who are right about the direction, but wrong about the timing suffer more than those who are wrong about the direction. Let's talk risk. The volatility during the handover window may far exceed your endurance. In the March 2020 example, gold went through weeks of torment before rebounding. 2026 GHT be even more intense, as the back Jan and Jan 4th between Iran peace talks and breakdowns will create dense 2 Jan way shocks. Today's 45 yuan drop might just be the appetizer. Being right about the direction but wrong about the timing comes at a concrete price. If you panicked and sell today, only for Trump to suddenly announce a major breakthrough in talks 3 weeks later, oil prices crash and gold rebounds by 150 yuan, you will face double costs, selling near the bottom and buying back at a higher price during the rebound. Conversely, if you go all in today and tomorrow's CPI sparks a second wave of selling, gold drops another Yaolin, the floating loss in the short term might make you crack and sell at the true bottom. Both mistakes share a common root, making extreme position adjustments during the handover window. So, what should you do? I'll use concrete numbers as an anchor. Suppose you have a 20 lininin. Today's 45 yuan drop means you are down about 70, uncomfortable, but fully controllable. But if you went all in and bought 50 yuan, lininin last week at 4710, today's drop means a floating loss of over 500 yuan. If it drops another 2% tomorrow, your loss could expand to 2000. The problem isn't the direction. The direction might be right. It is whether your position structure allows you to survive the handover window. What does surviving mean? It's not about feelings or faith. It is about 3 specific numbers you can confirm today. First, calculate the percentage of your liquid assets currently in gold. If it is below 50%, the current volatility has limited impact on your portfolio. Your problem is having too little, not too much. But this isn't the time for a massive, 1 Jan time all in, but rather a time for gradual accumulation. If it is over 50%, you need to ask yourself, honestly, if gold drops another 50% in the next 2 weeks, can you handle that level of drawdown? Second, confirm the form of your gold ETFs. Assets like GLD or IAU will have higher volatility than physical gold coins or bars during the handover window. The reason is simple. ETFs are the primary vehicle for fast money. And fast money is exactly who is being shaken out. If your entire gold allocation is in ETFs, you are sitting on a volatility amplifier. You don't need to convert it all to physical, but you need to be aware of this amplification. Third, whether you hold gold or not, open your Citi and check the bond allocation in your target Jan date fund. During the 9 months that the Fed is cornered, interest rates will likely stay high or continue to rise, and your bond allocation is suffering silent losses. This won't improve after the handover window ends, because even if gold rebounds, your bond issues will remain. Finally, let me paint a scenario you need to pre-Jan rehearse in your mind. Suppose tomorrow's CPI hits 5%, exceeding everyone's expectations. Within 15 minutes of the data release, gold crashes by Yaolin, your account shows startling red numbers, and your finger hovers over the sell button you sell. 3 days later, Trump suddenly announces constructive dialogue with Iran. Oil prices crash by 50%, gold rebounds over 150 yuan in 48 hours, easily returning above your exit price. You panicked and sold at the bottom, hesitated on the rebound, and chased it back during the breakout. After 1 cycle of operations, your holdings are unchanged, but your cost is 50% eager, and your confidence in your own judgment has been completely destroyed. This isn't a hypothetical. This is the cycle countless retail investors have actually experienced over the past 10 weeks. The cost of being wrong about timing is always greater than the cost of being wrong about direction. Today's entire analysis can be compressed into one core judgment: gold dropped 45 yuan today. But what determines your wealth isn't this 45 yuan, but whether you understand that the Fed is stuck in a dead end, unable to raise or cut rates. The last time this happened was the Arthur Burns era, 1972-1974. Burns vacillated for 3 years. Inflation spiraled, the economy recessed, and the US faced stagflation. Those 3 years were the starting point for gold to rise from 63 yuan to 184 yuan, and eventually onto 850 yuan. Every short Jan term dip is a reaffirmation of the long Jan term structure, because the reasons for the dip's accelerating inflation, war Jan-driven oil prices, and collapsing rate Jan cut hopes are precisely what are deepening the Fed's predicament, and the deeper the Fed's predicament, the higher gold's long Jan term floor. The cause of the dip is the reason it will rise. This isn't an argument. It is the fundamental physics of a central bank in paralysis. If you feel anxious today when you open your account and see red, that is completely normal. In an era where the central bank is trapped, wars fluctuate, and inflation data moves like a roller coaster, questioning your own judgment isn't weakness, it is clarity. The real danger isn't doubt, it is the impulsivity to press sell when you are in doubt. You've spent Arshafindron watching this to understand the true structure behind the Sishuumerin drop, rather than reacting out of fear to a single number. That itself puts you in a different position than most retail investors operating out of panic. When markets fluctuate and emotions are being torn apart, holding on to one's own judgment is the hardest thing to do. This gold structure bull market inner menu I prepared is meant to help you see through short, Jan-term volatility and grasp the underlying logic. Thank you for watching. Those who have stayed until the end are undoubtedly the veteran viewers of Light Zan on Zan Insight. If this content has provided some inspiration, please subscribe to the channel, give it a like, and share this video with friends who are following macroeconomics. If you have any thoughts or questions, let me know in the comments. See you in the next episode.